Live from New York, 20 seconds away from the opening bow this morning. Good morning. Coming off the back of the biggest weekly loss on the S&P 500 since June on the Nasdaq. Even further back than that, futures down 0.9% on the S&P. On the Nasdaq, we're down about 1 full percentage point. On the Russell of small caps, we're negative a little more than 1 full percentage point. That's the opening bow. Switch up the board and get to the bond market. Yields higher, much higher. On a 10-year by 5 basis points, 349.63. Remember, everyone said the highs of the year would be in June. Well, we took out the June high a little bit early this morning, 350 on a two-year that's been climbing for 8 consecutive sessions, up 9 basis points, and now looking at 396 on a 2-year yield in America. Without doubt, you can imagine the dollar is a whole lot stronger. It is right now. Euro dollar negative 0.4%, 99.77 on euro dollar, and crude heading south. We're down 3.29% on WTI at $82 and about 30 cents. 30 seconds into this one, around the opening bow with your movers. Here's Abby.
Hey, John. Well, it really does have everything to do with those rising yields and that stronger dollar pressing stocks down. That's especially true for big tech. Microsoft down more than 1% at this point, down 1.1%. Something to keep in mind, last week we, of course, had a number of companies, big conglomerates, pre-announcing to the downside. Microsoft was one of the first to do that on the foreign exchange effect. Let's see if there's more to come there. ExxonMobil down 2% as oil, as you were just showing, falling even more. That stronger dollar pressing risk assets overall. JP Morgan, though, banks not getting a bid from rising yields. This as the yield curves invert a little bit more, the short end going up more than the 10-year yield, or the longer end, I should say. And then finally, I will dare to mention crypto and Coinbase and Bitcoin. Bitcoin technically very weak, on the brink of a bigger breakdown that it's already done. That is, of course, weighing on everything related to crypto and Bitcoin. Coinbase down more than 4% on the session, John.
Tough session for everything and everyone right now, Abby. Thank you. Stocks down, bonds down, yields up. When will that positive correlation between those two things break? Right now, toxic for pretty much everyone invested in the market. Yields higher, equities lower by 0.8% on the S&P 500. Energy where the underperformance is, we're down 2 percentage points. Information technology down about 0.8%, extending the declines on tech stocks after the Nasdaq just posted the worst week in 8 months here in New York. For more, here's Ed Ludlow. Hey, Ed.
Good morning, John. We're down 0.7% on the Nasdaq 100, off that worst week since January, in a week where the Nasdaq 100 shed almost $900 billion of market cap. What's interesting is this is not just the most speculative corners of the market. The mega caps, the growth or quality stocks also caught up in this. If you look at the losses of the last 5 sessions, half of it came from just 6 single names, the creme de la creme of mega cap technology shares. We had the prospect of the 75 basis points hike by the Fed this Wednesday. Higher rates discounting the present value of future profits, but then there's the narrative around 100 basis points, right? The outlook for global growth. Could a slowdown in the global economy also erode the profits of these tech companies who so far have fared well? We've got about 77 stocks down on the Nasdaq 100. One pocket of green is Netflix. You talked about that upgrade from Oppenheimer, the latest street name to talk about an ad-supported tier, but elsewhere we're seeing declines in most names, apart from Nvidia, interesting one, up 0.3%. Really interesting, the ARK Innovation ETF loading up almost 400,000 shares of Nvidia this month alone, John.
Ed, thank you, buddy. Good to see you here in New York. Ed Ludlow there, breaking down the tech moves. Alluding to the bond market move as well. What a move we're seeing at the front end of this yield curve, up 8 basis points, 395 on a 2-year. 3,360, clean break of 70, 80, 90, and now talking about 4%, 5 basis points away on a 2-year. The 10-year flying as well this morning. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, it's been absolutely wild. 3.5% on the 10-year realistically is what we're looking at on the nominal yield. When you adjust for inflation and take a look at that 10-year real yield, it's now sitting at 1.13%. That is the highest going back to 2018, and that is very problematic for equities and specifically tech stocks. Over the last month, the Nasdaq 100 down about 11%. It's down 27% year to date, and of course, borrowing costs being higher has everything to do with that. What's interesting is we've seen prices come down so substantially for tech stocks, that's even as earnings estimates are essentially hanging in there. So all of that multiple contraction, forward multiple contraction, has been on the price side. Where that PE multiple stands now going forward, about 22 times forward earnings. So yes, that is down from where it was just a couple of months ago, but still that remains elevated relative to history. So these stocks are still expensive. And obviously we're talking about public companies, already public companies here, but on another note, this is hitting the primary market too. Not a lot of tech companies think they will find a warm welcome in the public markets right now. About $667 million worth of tech and communication IPOs have been announced this year. Almost all of that was back in January. And actually, year to date, across 8 months combined, there have been fewer tech offerings than in any individual month last year, John.
Those numbers are absolutely incredible, or the lack thereof. Just the zeros at the bottom of that chart. Kelly, thank you so much. Yields up, tech down. It's an easy to understand story. Dan Ives of Wedbush has this to say. The Fed backdrop clearly is making this a brutal market for picking tech stocks, but we're not throwing in the towel on our long-term bullish thesis for the sector. Dan Ives, I'm pleased to say, joins us now. So Dan, you took us there. Let's begin there. You've got a 220 price target on Apple. We've just had a 100 basis point move in real rates since the beginning of August. How do you get to 220 on Apple if that's the rate backdrop?
Yeah, look, I mean, and clearly it's a brutal backdrop for tech stocks, but for Apple, it's a good example. I mean, I look at iPhone 14, it's tracking what I believe is mid to high single digits above iPhone 13. I think the growth and the underlying numbers, Street is still underestimating. So I think Apple's a name. You're going to see this digestion period, and obviously in terms of the Fed backdrop, but in terms of growth and in terms of what's happening on services, that is still underestimated in terms of what we see. And that's why I believe Apple here, risk reward makes it just a compelling, I view as a table pounder name if you have a horizon 6-12 months out.
Dan, let's just sit on that. Just the shift to the higher ASPs as well in Apple units. Is it just about the volume or the average selling price as well that's giving you a little bit more confidence?
Yeah, I mean, we think it's about 80, based on our estimate, 80 and 90% are Pro Max. That goes to 60-65% in the year ago. So that's significant for ASPs, for revenue, for Apple. I think a lot of that is China-driven. We're seeing many more go toward the Pro and Pro Max. And overall, despite this dark storm cloud in terms of the economy, brisk sales, in the U.S., even what we've seen over the last week.
Dan, are you confident they can meet that demand on the supply side?
Well, I think they have done almost superhero-like ability, what Cook and Cupertino have done in Asia to get ready for iPhone. We think 90 million units was the initial order, and that's already in stone. I think they could be potentially upping those units in terms of what they're going for. Supply, I think the worst is in the rearview mirror, and that continues to be our thought in terms of tech. One of the biggest risks was the supply chain, and we're starting to see it significantly moderate, and that's why it's bullish for Apple and it's bullish for names like Tesla that we see in China.
Dan, where does the consumer fit in here stateside, when many people are forecasting a much, much weaker one over the next 12 to 18 months? How does that fit into the bullish thesis around what is essentially a high-end consumer-priced piece of hardware?
Yeah, look, I think it's easy to just paint it with the same brush, say economy, consumers are not going to upgrade. John, I look at our numbers, and I think there's about 240 million of a billion iPhones that have not been upgraded in 3.5 years. I mean, the pent-up demand is massive, which is why this continues to be able to power through any sort of economic downturn that we're seeing. I believe that's what we're seeing play out. And I think when you look at Apple, it's one, even on the services business, that's when it's going to see an uptick. And that's why I just continue to view Rock of Gibraltar names, Apple, Microsoft, some of the cybersecurity names like Palo Alto and Zscaler. It's clearly easy to yell fire in a crowded theater here on tech. But, our best calls have been in these environments in 2000, 2001, 08, 09, and early 2020. And that's why we continue to stick to our knitting in terms of tech.
Do you need lower yields for this to work, though, Dan? Do you need a repricing of yield to lower for these calls to work?
Well, clearly the fight in the Fed, continues to see a risk off and multiple compression. But I do believe a lot of that started to get priced into these names. And I believe it's the most negative we've seen tech investors going back probably 2009, 2010 in terms of these names. So I'm just saying a lot of bad news, not just Fed and macro baked in relative to what we're seeing growth. And also the enterprise names are holding up well. Microsoft, Oracle, among others.
There was one name you didn't mention in all of that. You named most of the big tech names, the likes of Apple at the front of it all. Dan, you didn't mention Facebook. How do you think these social media names are going to hold up in the face of slowing growth, not just domestically but worldwide, and tighter Fed policy?
Yeah, well, I think there's a bullseye on social media names, specifically names like Meta. I think they're going to have hurricane-like headwinds, not just because what we're seeing in terms of slowing macro, but also digital advertising dollars and what's happened with Apple iOS privacy issues. And I believe social media, that's why you have Facebook going to the metaverse and some other areas. And I think numbers could continue to be under pressure over the coming quarters. That's why in tech, it's a bifurcated tech landscape. We stay away from social media names. We continue to focus on enterprise and our core consumer names.
Dan, got to fit this in. You're a bullish guy. Some people would say certain names are permeable. Apple might be that name, and I'm sure you'd appreciate that. Can you tell me the number one risk to your bullish thesis at the moment for that name?
Yeah, the number one risk is China. I mean, that can, from a supply perspective, that is the number one risk in terms of Apple, despite everything that we've heard. And at least so far, what we're seeing, going back even to the last month, I feel a lot of that pain and bad news from a supply chain perspective are in the rearview mirror.
Dan, good to catch up, buddy, as always. Dan Ives of Wedbush, bullish on the likes of Apple, much less so on the likes of Meta. Coming up, global equities remaining under pressure following their worst week since June.
And we have even more conviction in the need to be defensive at the moment, so I understand a bit the fact that risk assets today and in the coming days may remain under pressure.
With equities down about 0.5%, that conversation up next.
we have even more conviction in the need to be defensive at the moment. So I understand a bit the fact that risk assets today and in the coming days may remain under pressure. This said, within this difficult environment, the fact that we may not be far from the peak interest rates in the US is reassuring for the outlook. So there are a lot of uncertainties, but we see opportunities in the market at the moment that we didn't have a couple of months ago.
Stocks down, inching lower by a third of 1% on the S&P after a brutal week last week. The S&P 500 posting its steepest weekly decline, going back to the ugly lows of June. Taylor Riggs has more. Hey, Taylor.
John, and like you've been mentioning really all hour, tech is sort of the big underperformer of that. But like you said, really important to focus on sort of that broader market. So we'll hone in here on the S&P 500 as well. September has been traditionally a little bit of a tough month, and this month and this year is certainly shaping up to be no better. Still some of the worst months on the year, off about 3% or so. The average going back to 1996 for September is traditionally an 0.8% decline. So you're really seeing this year with that rate story, a lot of that underperformance and a lot of that volatility to really come out. You mentioned, though, technology. Take a look at this. The S&P 500 is down about $8 trillion year to date. $3.2 trillion of that is coming from the top 7 sort of big tech companies. And you see that. And I hate to be a broken record, but this does still feel like yields are rising, a rate of change that is really starting to put pressure on these long duration assets.
Equities trying to break away from the lows of this morning. Yields are still just off the highs of this morning. Taylor, thank you. Equities down about 0.25% on the S&P. The Nasdaq down by just 0.2%. But yields are still near the highs of the session at 295 on a 2-year, up 8 basis points on a day. On a 10-year, up 4 or 5 basis points, just short of 350. I said it earlier this hour. It's very, very difficult to find any constructive view on Wall Street at the moment. Maybe Marko Kolanovic and JP Morgan one, Chris Harvey of Wells Fargo another. This is Goldman and Morgan Stanley. This is what they've got to say. Goldman's David Kostin seeing the headwinds for profitability starting to pile up. Morgan Stanley's Mike Wilson echoing his views, citing concerns over tighter financial conditions and pressure on margins as well. Kaylee Lyons back with us for more. Hey, Kaylee.
Hey, John, a little bit of a broken record in that you can count on these two to be bearish more often than not. But what they're pointing out here really is you still have an inflation problem, a big one in the U.S. Not only does that put pressure on corporations on the margin side, but also to get inflation down, you have a Federal Reserve that is hiking interest rates aggressively, probably will again on Wednesday. And those higher interest rates put pressure on corporates too. So that is why you see the S&P 500 down roughly 19% on a year-to-date basis. But there's something going on in this chart that doesn't necessarily match up. As you've seen those dramatic declines in equities, earnings estimates pretty much holding in there. They are still right around record highs. And actually, if you look at analyst estimates for both 2022 and 2023, they still imply that rolling 12-month earnings will maintain an upward steady slope. So even in the face of growing recession risk, that is still holding in there. And Mike Wilson has pointed out in his note that revisions are often glacial in pace and that there's still a long way to go before reality is fairly priced. In his base case, the S&P bottoms near 3,400, though he said in the bear case recession scenario, it would be more like 3,000. Those on Wall Street, though, aren't quite as pessimistic. The average year-end target currently is at 43.46. The average EPS estimate at 2.24, though that is down significantly since the start of the year. You can see there that average forecast has been trending steadily lower for months now. We're down about 500 points below what it was back in April. But if those earnings estimates start to more materially roll over, John, it's likely that those index level estimates are going to fall further too.
Kelly Lyons, thank you. Mike's been talking about this for a while. Mike Wilson has absolutely nailed it so far in 2022. Rate shock first, we've had that. Have we seen that fully materialise? Now he's looking for the earnings shock as well. Mike Wilson this morning, Kelly talked about some of those numbers. Let me repeat a few. We believe the S&P 500 will bottom near 3,400 in our base case. Went on to say 3,000 in our bear case recession scenario before rebounding in the first half of next year as visibility around a growth reacceleration forms. Just a rare hope there in a paragraph from Mike Wilson. Right now 38.59 on the S&P. That's the equity story. About 20 minutes into the session. Let's get you some sector price action. Here's Abby.
Hey, John, well, let's take a look at what is happening for the S&P 500 sectors because we are off of the lows, and that means not all S&P 500 sectors are lower at this point. Now, interesting, because we've been focusing so much on the tech weakness, we actually have healthcare as the worst sector on the day. Right above it, real estate. These are yield-sensitive sectors. So for the first time in a long time to my memory, we can actually see that these yield-sensitive sectors are acting as they should. They're down when yields are higher because their dividends look less attractive. Tech down, though, also about 0.5%. But you can see the bulk of the sectors at this point are up modestly. It's going to be interesting, of course, to see how this day finishes. Over the last week, or I should say last week, tech absolutely brutal. The sell-off at one point, the S&P 500 tech index over the last week had been down 7.5%. That was at that point the worst week, going all the way back to March of 2020. You can also see that the SOX, the New York Stock FANG index, with a lot of those China tech stocks, and in fact that Golden Dragon China index down 8%. So tech in a rough spot as yields just continue to back up. Let's see whether or not that dynamic continues. Today, a little bit of amelioration of that situation.
It's trying to stage a recovery off the ugly lows of early this morning. Abby, thank you. We're down 1/3 of 1% on the S&P, down about 1/3 of 1% on the NASDAQ as well. Coming up, we'll bring you the trading diary and we'll touch base with our good friend Guy Johnson over in London. We'll do that next. From New York, this is Bloomberg. Historic time in the United Kingdom. Queen Elizabeth II's coffin arriving for the long walk procession to St George's Chapel in Windsor Castle. Guy Johnson joins us now from London. Guy, describe the next couple of hours for us.
So what is happening right now, John, is the royal hearse, which has made its way from central London, Hyde Park Corner. It is now making its way through West London. It's left West London. It is now approaching Windsor, and it's making its way for Windsor Castle. It's ultimately making its way to St George's Chapel, where the committal service will start at 4 p.m, John. After that, the Queen will be buried in the King George VI Memorial Chapel, and her husband's body, Prince Philip, who died last year, will ultimately be moved to rest beside her as well. So that's going to happen over the next few hours. What we've just seen today is obviously the state funeral. That was for the world. This is more for family. This is more for friends. This is the royal family coming together to pay its respects to the Queen and to say goodbye, John.
And Guy, the official period of mourning in the country closes. I just wonder what that means for Prime Minister Liz Truss, Guy. Is it back to business as usual? Because business is not normal in the UK.
I heard Lisa joking about this a little bit earlier on, John. Business as normal, confronting reality. I think all of this is going to be the narrative for the next few days. The Prime Minister has an incredibly busy few days. Her government has an incredibly busy few days. She's going to go to New York. She's going to go to the UN. She's going to have a bilateral with the President of the United States. We think that's going to happen on Wednesday. Before that happens, though, we understand that we're going to get details of the energy plan. That's going to come out on Tuesday and Wednesday. We've also, of course, got the Bank of England coming up as well. and we've got this mini fiscal event taking place on Friday. We are waiting to find out exactly what the details are going to be announced in that. So a period of mourning comes to an end, and this is a country that does need to confront the reality of a very difficult economic situation, a very difficult winter upcoming for the United Kingdom.
Guy, what do you make of the sequence of that? And do you think that Governor Bailey would prefer to be on Friday and the mini-budget on Thursday?
I think he would have a better idea of what is obviously going to be the final detail contained within that budget. I would hope, I would imagine that there is maybe some lines of communication between the Treasury and the Bank of England so that they do have an idea of what is ultimately coming towards them. In the past, fiscal and monetary authorities have worked very closely together. It's going to be interesting to see whether that does take place again between this Chancellor and this Governor. But I would hope at least they would have a clear understanding of what that fiscal event is going to look like. I think it's the Fed that they'll be watching over their shoulder carefully for. I think that will make the decision-making process at the Bank of England even more tricky, I think, John.
Sure.
And maybe it's not the fiscal event, it's the Fed that really is going to muddy the waters there for
With
them.
sterling looking at 113 again today. Guy, looking forward to the coverage alongside Alex Steele. Guy Johnson, our good friend, is going to catch up with the whole situation in the UK over the next couple of days. He's going to kick things off in about 5 minutes' time. Going to kick things off with you with the trading zone and the rest of the week's look ahead now. US housing starts on Tuesday. Busy Wednesday, kicking off with existing home sales. Then President Biden delivering a speech at the UN General Assembly. The big bank CEO speaking on Capitol Hill. The main event, a Fed rate decision followed by Chairman Powell's news conference. Central bank decisions from the BOJ and the BOE coming on Thursday. The Bank of England is in such a tough spot right now, as is the BOJ. Then we get another round of initial jobless claims as well on Thursday, and US PMIs to close out the week on Friday. With your equity market staging somewhat of a recovery at the moment, we're down about 0.2% on the S&P. On the Nasdaq, almost flat on the session. Given what's happening in the bond market, that's somewhat surprising. Yields up 8 or 9 basis points on a 2-year at 3.95. From New York City, good to be back with you. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, September 19th. Here are the top market stories that we're following for you at this hour. Betting on the Fed. Investors debate that 75 or 100 basis point hike from the Fed Wednesday, while the market still prices in cuts for next year. And hedging the Fed. 10-year yields hit 11-year high. 2-year yields near 4%. Stocks weaker, dollar surges. We find out how to hedge the next 48 hours. And it's not just the Fed. A slew of central banks meet this week, representing 500 basis points of hikes. The Bank of England confronts an energy crisis, a new government, and the loss of its queen. From New York, I'm Alex Steele with my host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, the price action over the next couple of days is going to be quite interesting. I thought we were going to be opening a little bit lower when it came to the equity market, but now we're just down by 0.3%.
Yeah, I'm trying to figure out what's happening in the bond market. I think that really is the conundrum today. We are seeing certainly a significant sell-off. We've got a lot of central banks to think about, but the FOMC obviously preeminent in all of this. So what is going on? What is the market moving around today? I don't know the answer to that. I'm hoping Ira Jersey is going to have an answer to that. He'll be joining us in just a moment, our US interest rate strategist. We are getting some data though, Alex. So let's talk a little bit about that. The National Association of Home Builders Housing Index is out today, and it continues to soften. We're at 46 now. The prior number was 49. The survey was 47. Now we get housing starts tomorrow, which I think is going to be really interesting as well. But this is one of the main transmission mechanisms, obviously, for the Fed, and we would expect those numbers to be rolling over. It is desirable, I would have thought, from the Fed's point of view, that this is a market that slows up. But I'm curious to see what happens when it comes to the MBS holdings the Fed has currently on its balance sheet. What's it going to do with those? So let's talk a little bit about the Federal Reserve. I should probably just say why I'm here.
I was going to say, that's a beautiful shot you have.
Well.
Where are you?
Well, I'm on the other side of the river, so I am just next to Lambeth Bridge here in London. So that's a live shot behind me, you can see. It's really quite incredible. Palace of Westminster, Westminster Abbey on the far side of it. The action, obviously, behind me this morning here in London as we saw the state funeral of Queen Elizabeth II. She is now moving towards Windsor. The state hearse is carrying her there. There will be the committal service, which is going to kick off in an hour's time, and we will obviously show you some of the pictures coming from Windsor a little bit later on. But Alex, the Federal Reserve kicking off its two-day meeting a little bit later on. It's going to start tomorrow. Question of the day, how do you hedge the Fed? Joining us to figure out all of this, as I mentioned, we have Bloomberg Intelligence Chief US Rate Strategist, Ira Jersey, and Bloomberg's Kriti Gupta. Give us a kind of sense of what else is going on, because I'm trying to figure out how these markets are moving this Monday. Ira, I'm going to start with you, because I think you're at the center of the action here. We're trying to figure out how to hedge the Fed. What is going on this morning with the bond market?
Yeah, so we're seeing more flattening in the yield curve. I think that's not a big surprise, given that the risk is for the Federal Reserve to hint that they're going to go even higher than what the market's pricing in terms of the dot plot, for example. So remember, with this meeting, not only do we get the post-meeting press conference, but we'll also get the summary of economic projections. So we'll see what do the members of the Fed think for both the economy, inflation, real growth, and importantly, that dot plot. I think the single biggest thing that I think the front end of the curve is starting to price for, and why you see two-year notes up almost over 8 basis points at the moment, is that if the Federal Reserve, even if they hike to 4.5% or 5%, like Bloomberg Economics and Bloomberg Intelligence think, if they keep the rates there for say 18 months, then it makes perfect sense for the market to be pricing for what it is. If we had been pricing for pretty early cuts, and if those cuts don't materialize, or the market doesn't think that they'll materialize, then two-year yields can go even higher.
I mean, we're like a stone's throw away right now from 4% on the two-year. That's going to be pretty impressive. Kriti, I'm wondering why the equity market isn't down more.
Well, it was down more. It was down almost 1% in the pre-market, and I think this is crucial here, because I think the question of the day is, how do you hedge the Fed, right? Well, you're doing it right now. You're having this kind of turnaround story when it comes to the stock market. I'm going to throw out a stat here from our very own macro man, Cameron Christ, because I think he phrased it perfectly. A lot of the kind of down note that you're seeing this this morning is really a hangover from options expiry that you saw on Friday. The heavy volume, a lot of people getting out of their positions ahead of the weekend. That being said, you do tend to see a little bit of a down note before the FOMC meeting. That's been a trend definitely throughout 2022, and I'd argue throughout 2021 as well. But the stat that came from Cameron Krice here was that Friday was the 9th monthly expiration of the year, the 8th time that the stock market has fallen during the expiry week, and 6 out of those 8 times the following week you see a rally of about 1.3%, or actually, excuse me, 1.5% on the week. So potentially that's what's starting to happen right now. The idea here that you're kind of selling the rumor, potentially buying the news on Wednesday.
Kriti, one of the other questions that Cam asks is, where do you put your stops? And this is, I think, what a lot of people are trying to figure out right now, the extent of the moves that we could see this week. How much volatility are we expecting? And how do you think people are positioning around that volatility? To come back to the question of volatility, to come back to the question of the day, how do you hedge what is going to be a really bumpy week potentially?
Well, you asked Ira that question, right? What the heck is going on with the bond market? Well, the expectation in the equity market here is that as we go throughout the week, the rates volatility will actually decline. And if that is your base case, that going into Wednesday, you'll actually see a lot of what you're going to hear on Wednesday priced into the market already, the 2-year, the 10-year flattening of the curve, you name it. Then the equity market, the best way to play it is to start having those call options baked into the market. I've spoken to several traders this morning, and all of them are saying that all the action in the equity market is really going to be a function of the derivatives market. So I think that's where you want to keep your eye here, that especially in those call options, that's where you're going to see heavy volume.
Hey, Ira, if we hit 4% on the 2-year, what happens?
Yeah, I think we probably keep going, and that'll be a signal, I think, that the market is really thinking that we are going to have that higher terminal rate, and the rates will stay there for a long time. I think there is a little risk here, and we talk about hedging the Fed. You know, I think with how much flattening we've seen over the last couple of trading sessions, you know, the risk really might be that the Fed goes 75 basis points, and even though they might hint that they could do 75 basis points again in November, that might be a little bit of a relief for the market, and you might actually see a little bit of an unwind of the flattening that we've seen in the last couple of days.
Okay, let's just think, if that is the psychology and the Fed is aware of that, Ira, is 100 a possibility?
So first, I'm not 100% sure that a lot of members of the FOMC are aware that that's a psychology, but you know, 100 basis points is possible. I'm not going to say it's a 0% chance, but I think that from the Fed's point of view, they'll bring up long and variable lags, the fact that they don't want to seem like they're panicking because of the CPI number, and we did get a reasonably weak retail sales report, right? So the data has been much more mixed. If it was all one way, then I'd say that maybe there's a higher chance of 100 basis points, but it hasn't been. And you look at a lot of the survey measures of the economy, and they continue to trend lower. So I think from the Fed's perspective, it's go 75, reevaluate, and then go 50 or 75 in November, depending on what the intermeeting date is.
Kriti, when you talk to investors and traders, what asset is the most vulnerable right now into the Fed?
Oh, geez, that's a tough one, because arguably it's all of them, right? I mean, I would actually say maybe keep an eye on the dollar here, because it's such a crowded trade at the moment. It kind of seems like a no-brainer here that if you have higher interest rates, if you're pricing in any potential for 100 basis points, even if it is a small chance, then that should create an even higher dollar. But just given how crowded of a trade it is, I think that's the reversal that a lot of people have to watch for.
All right, guys, thanks a lot. We really appreciate it. It's a perfect way to set up this week. Bloomberg's Kriti Gupta and Ira Jersey of Bloomberg Intelligence. Thank you very much. All right, coming up, more on the question of the day, how do you hedge the Fed? We're going to talk with the chief equity strategist over at LPL Financial, Quincy Crosby, coming up next. This is Bloomberg.
All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it. Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
And investors have to remember the Fed does not care about the stock market. The stock market is not part of the Fed's mandate. I think there's too many factors that are going to drive it down. You're fighting seasonality. September's a weak month. You've got an aggressive Fed. You have kind of a weakening global macro viewpoint. So I do think we're going to retest the lows, if not go down to 3,400. You know, I think this was a classic bear market rally, and typically when that happens, you come down and you push a little bit lower. So we are firmly in the bear camp right now.
That was Victoria Green of G Squared Private Wealth with a sobering outlook there for equity investors at the head of the Fed's two-day meeting in Washington, which leads us to the question of the day: how do you hedge the Fed? How do you hedge the next 48 hours? Joining us, Quincy Crosby, Chief Global Strategist at LPL Financial, which has about $1 trillion in asset under management. Question to you: how do you hedge it?
Well, you know, sometimes the best hedge is no hedge. You just wait it out. And statistically, on the Fed day, when we have the press conference, the market actually does pretty well. And it usually comes because Chairman Powell, unless he comes back into his Jackson Hole, Wyoming mode, usually has a couple of sentences which sound a little bit softer than the initial message. And the market typically ends up. But that said, you know, we've been fairly conservative in the portfolio. We would stay there, defensive. Although I have to say, Alex, it's been interesting to see consumer discretionary get a bit. It's not just today. We saw it last week, even in a difficult week, market selling. We saw consumer discretionary getting a bit. And that's a positive for the market, because if you could pull out of staples, move over to discretionary, it suggests that the market is looking ahead 3 months or so. And again, I think that this market does have to pull back more, and it could come down to 3,500 or even below, and then we capitulate and go into the election and actually have a strong run.
Quincy, good morning. What does capitulation look like to you?
It looks ugly. It looks really ugly because, you know, we could go test the June lows. What is that? 3,666, which is also a horrible kind of number, but come down below and then go to 3,500 or even test it below. It would be healthy. It would be clean. And more than that, much more than that, and more important, is it brings the valuation of the S&P 500 at a very attractive level. And then you could see investors coming in, traders coming in, and believing that we have bottomed and we can start inching our way higher.
In the meantime, Quincy, do you sit in cash? Do you buy treasuries here with the 2-year yield almost at 4%? Is it a dollar story? What do you do?
Well, you know, if you're going to go into fixed income, the short duration is attractive, extremely attractive, and also even short duration corporate's attractive. But in terms of the equity market, I think you have better entry points as we not just test the June low, but go below it.
In terms of what happens then, Quincy, in the past few cycles, we've seen equity markets coming roaring back, i.e. it's been a sort of V-shaped recovery. You have been very unlucky to have missed the bottom because things move very quickly after that. How do you see the bottoming process happening here, and how quickly do equity markets recover post that low?
Well, remember, you know, the ones that we have been through over these last few years, it hasn't been about inflation. It hasn't been about the Fed fighting inflation. We have to take the Fed at its word. I think the 2-year U.S. Treasury is taking the Fed at its word. And so I think it's as soon as the market realizes that the Fed has achieved its goals that the market starts to transition. And I don't think it's going to take that much because they've been incredibly aggressive. I think that's the reason you're hearing in the chatter. Maybe, just maybe, they come in with 1%, 100 basis points to get it over with. Because they have the luxury right now of a still solid underpinning for the market, the economy. They still have a labor market that's solid. They know that they may have to go higher, and they will do it. They could bring the unemployment rate well above 4% to 5% or even 6% if they have to. I don't think they want to do that, but they will.
So, Quincy, if we do get 100 Wednesday, what happens to the market? Is it good or is it bad?
You know what? I actually think, look, the algorithms get in there first, Alex. The algorithms will have an opinion on it. But I think ultimately it could scare the market that the Fed believes it's going to get a lot worse. But I do think that the market would ultimately appreciate it. Just clean it out, get it out, come down, and, actually do what you look for when you look for capitulation. Even on Friday, we saw the VIX climb a little bit higher. It's still within that range of why doesn't it get higher than that? Well, maybe we would actually see that if they went 100.
Quincy, when you think about, sorry.
No.
When you're thinking about what comes next, what kind of time frame should we be thinking of? If I'm an investor and I'm looking for investments that are going to work for me over 3 to 5 years, how easy is it to determine those investments at the moment?
Well, you're going to take a look at we know what investors like. They love the big tech names. And unfortunately, they are suffering as the yields climb higher, particularly the 10-year going across 3.5. But at some point, they become incredibly attractive, again, if you're a long-term investor. But how do I say this? You can't panic every time that market sells off. But by the same token, we're looking at consumer discretionary. We're looking at tech. We're looking at the other side of the market that tells us we're getting out of it. You know something? October is known in the history books as the bear killer, the bear killer. The Fed could get us there and kill this bear by having aggressive rhetoric, by going ahead. It's early November that we have the next meeting, giving us maybe another 75 basis points. It will get this market down to a level. And by the way, that level could be very low. Historically, the S&P 500, when we finally get rid of the bear, is just under 14 times forward earnings. It's nasty, it's cruel, but it sets the stage for buyers, not dippers, not buying on the dip, but buyers coming in for the long term. It becomes very, very attractive.
Yeah, that's definitely a long way to go. Quincy, thank you for the update. We really appreciate your time. Quincy Crosby, LPL Financial Chief Global Strategist. Okay, still ahead, President Biden underscores the U.S. military commitment to Taiwan in the event of an attack by China. We're going to have more on what he said over the weekend next. This is Bloomberg.
We agree with what we signed on to a long time ago. And that there's a one China policy, and Taiwan makes their own judgments about their independence. We are not we're not encouraging their being independent. We're not that's their decision.
But would U.S. forces defend the island?
Yes, if in fact there was an unprecedented attack.
That was President Biden speaking during an interview with 60 Minutes that aired on Sunday. Let's get more now from Bloomberg's Anne-Marie Hordern, which joins me now in New York. Anne-Marie, where's the walk back from that comment?
Well, there was a White House aide that came out, told 60 Minutes that the policy has not changed, but this continues to happen. Most recently happened in May. The president was asked, would you defend Taiwan? And he just said yes. Then the White House came out and they said, well, that means more military hardware. We'd be able to send more aid and support to Taiwan. This was different because this was, will you send U.S. troops? And the question was different, unlike the current situation in Ukraine. And the president said, again, very direct, yes. That was the answer. So while they're saying that they haven't changed how they view Taiwan independence, they don't want to get involved in that, the president was pretty clear that they would go and defend the island.
So, Anne-Marie, currently policy in theory has not changed. But what happens if we do get the Taiwan Policy Act becoming law? Because that would designate Taiwan as a major non-NATO ally. That is a step in a completely different direction because that's going through Congress now.
It is going through Congress. This is a big talk in the foreign policy community in Washington, D.C. You already have this Senate Foreign Relations Committee okaying it. They want to see this go through, and not just declaring Taiwan a non-major NATO ally, but sending more already of that military aid to Taiwan. What it will do is just deteriorate further the relationship between Washington and Beijing, which we already see this summer really sour with Speaker Pelosi going over to Taiwan. You had China come out and cut off talks with the United States on climate, on military, the military drills that they conducted, the most provocative we have seen in the Strait. And at the same time, this would just make those relationships that much tougher. And it comes at a time as well that Xi Jinping is really pushed by the nationalists in his party to make sure he is talking tough and doing these military exercises when these issues come to fruition, because of course he's about to have an unprecedented third term that he wants to make sure that he glides through.
Is this part and parcel of also heading into the midterms? Like, does this play well in the midterms, or is this sort of Biden also riding a recovery high at this point?
I think this is maybe partially both. On one hand, this is Biden continuously saying what he has said. This is the fourth time he has said this and kind of gotten himself into hot water when the White House comes out and tries to tamper it a bit. This is what they would call strategic ambiguity, right? And he's continuing that. But also, heading into any midterm election, whether you're Republican or Democrat, it is always smart to talk tough on China.
Is this also a response to the meeting we've just seen between Vladimir Putin and Xi Jinping? There was a quid pro quo. We'll support you on Ukraine, you support us on Taiwan. Is there a relationship with what we just heard on 60 Minutes and what was said there?
Well, the president has said this before, so in that sense, it's not exactly, but the timing for him to want to talk tough and make sure he's showing he will go to the defense of Taiwan is probably a message not just to Xi Jinping, but as you say, to Vladimir Putin. And Vladimir Putin also, in a rare admission to Xi Jinping, was saying, we know we've kind of put you in this difficult situation with Ukraine. But the president also had a comment on the war in Ukraine as well in this 60 Minutes interview. He said the support will not stop until the war stops, and asks, even though Ukraine has definitely in the past weeks or so has made up some ground, he said that if you look at the carnage, you cannot say that they're winning this war and that people think this war will be over. He would not agree with that assessment.
Anne-Marie, getting back to the midterms and President Biden's victory lap for a second, we're looking at Brent around 90, WTI at 84, UAE accelerating its plans to increase oil production. I'm wondering the conversation that Biden might have had with the UAE, or how this all sort of puts a nice little bow around all of this.
Well, the president was asked about inflation in the 60 Minutes interview, and what he is saying, and one thing the White House really has been trying to move the attention and focus when you ask about inflation is the fact that gasoline prices are lower. They were a peak of $5 a gallon in June, so right now hovering below $4 a gallon, some places $3. This is very good news for them. The White House would welcome this, right, because they want to see more oil coming from the Middle East to make sure they're quelling these concerns, especially going into the winter when these sanctions on Russia oil are really going to hit. I'm not sure there's any direct conversations because the UAE themselves have been wanting to do this for years. So this for them is also in their national interest, but I'm certain at least one part of the Democratic Party, the ones that don't want to get rid of fossil fuels as quick as possible, would definitely welcome this at this time.
Anne-Marie, thank you very much indeed, as ever. Bloomberg's Anne-Marie Hordern joining us in New York. Coming up, the Fed's efforts to bring down inflation could cause more harm to the United States and the global economy. We continue the conversation next. This is Bloomberg.